Conversion of a company into LLP. Now, before we get into the legal provisions, let me first explain to you what does this mean. Let us say there is a company X. Okay. Now, LLP as a means of carrying on business. You have learned in your class 11th and all those things, I believe. You would have learned that there are various forms of carrying on business. You can have a sole proprietorship. You can have a partnership firm, right? You can have a company. In company, the biggest advantage is that the liability is limited, whereas in case of partnership firm and the sole proprietorship, the liability of the owners is unlimited, right? But definitely the flexibility in case of partnership is more than that of a company. The reason being that the company is governed by the Companies Act in India, which prescribes a lot of compliances, right? Now, in order to provide people with the flexibility of owning a partnership, okay, but not subject to restriction of the company, the Indian regulators, what they formed was they had introduced the concept of LLP or Limited Liability Partnership. Okay. Now, in Limited Liability Partnership, it's a partnership, but the liability, as the word itself suggests, is limited. Now, in order to ensure that, there is a level playing field, which means that even the existing companies, the smaller one, can convert themselves into LLP, the tax law have provided that if a company transfers its assets, okay, to the Limited Liability Partnership, right, that transfer will not be liable to tax because it will not be treated as transfer for capital gains tax purposes. What this means is that even when the company transfers its asset to the Limited Liability Partnership, that will not be treated as a transfer and hence will not be liable to capital gain tax, provided certain conditions are satisfied. Right? Let us see these conditions one by one. When a private limited company or a non-listed company, so please note that these benefits are available only to a private limited company or a non-listed company, which means what? If a listed company converts into an LLP, I don't know how that will be possible also because there are a lot of regulations on listed company. These provisions are not applicable. So when a private limited company or a non-listed company transfers a capital asset or an intangible asset to a limited liability partnership, it shall not be considered a transfer where the following conditions are satisfied. So what we discussed here, these transfer will not be taxable if these conditions are satisfied. And what are these conditions? Total sales, turnover or gross receipt of business in company shall not exceed 60 lakh in any of the three preceding previous year. So let's say, for example, if you are transferring something in 2011-12, then the three preceding year will be 2010-11, 2009-10 and 2008-9. In any of these three previous year, the turnover, the sales or the receipts of business of the company should not exceed 60 lakh. This is the first condition. Second, all the assets and liabilities of the company immediately before the conversion becomes the asset and liabilities of the Limited Liability Partnership. So what this implies is that all assets and liabilities. So you can't just transfer one single asset. You have to transfer all the assets and liability to the LLP. Third, all the shareholders of the company immediately before conversion become partners of the LLP and their capital contribution and profit sharing ratio are in the same proportion as their shareholding in the company on the date of conversion. So let's say, for example, okay, let me use a different page maybe. Let's say, for example, there's a company in which there are three shareholders, 30, 30 and 40, right? This company converts into an LLP or transfers all its assets and liabilities. What this condition stipulates is that their capital contribution ratio and the profit sharing ratio, right, in the LLP will be the same as it was in case of the company. So if here you were entitled to 30% of the profits, here also you should be entitled to 30% of the profit. It cannot be that 30, 30, 40 becomes 20, 20 and 60. No. In that case, it will become taxable. So this ratio has to remain unchanged. Shareholder do not receive any consideration or benefit other than by way of share in profit and capital contribution in the LLP. You can't pay any cash to the shareholder. So they will give up their shareholding, okay, and they will receive the interest in the profit and the capital contribution of the LLP. The next condition, shareholders of the company continue to receive at least 50% of the profit of LLP for 5 years from the date of conversion. So even when you have converted, okay, even after conversion, this ratio which they were holding here it is what, 30, 30, 40, 100. But for 5 years, this ratio should be at least 50%, right? If it goes down below 50%, the profits or the capital gains which were not charged to tax earlier will become taxable. At least 50% of the profits of the LLP. And the last is, no amount is paid to the partners out of accumulated profits of the company for 3 years from the date of conversion. Now what does this mean? So let's say on the date of conversion, the company had profits of 5 lakh. And in the next 3 years, once it converted, they earned a profit of 3 lakh. Right? The provision, what it says is, you cannot distribute this profit amongst the partners for 3 years from date of conversion. Okay, you can distribute this 3 lakh amongst the partners, okay, amongst the existing, past or whatever, but you can't distribute this money for 3 years from the date of conversion. No amount is paid to the partner out of accumulated profits of the company for 3 years from the date of conversion. Right? So these are the conditions which, if satisfied, will not result in any tax in the hands of the company. Similarly, if all these conditions are satisfied, and this you can note down please, if all these conditions are satisfied, if all conditions are satisfied, there is no tax in the hands of shareholder on giving up their shares and getting share in LLP. So what happens here is, once this conversion happens, what happens is that the shareholders, they basically give up their shares, right? Because if the company itself is not into existence or it has converted into an LLP, then these shares do not carry any value, right? And they get their profit share in the LLP. But this by itself will not result into any kind of a tax in the hands of the shareholder, right? So let us now move on to the next slide.